So you do need to, unfortunately, consider life expectancy, consider age, consider, how much benefit you're actually getting from Centrelink and age pension as to whether this is even a viable thing and something that you should be doing.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. We are back again and back on the 360 podcast.
Back on the microphone, Andrew, bringing a whole heap of value to our listeners and our viewers. And today we're talking all about granny flats.
Granny flats. That's an interesting one.
It is an interesting one. I'm just even smiling at the word granny. Like, how's your granny going? Yeah. There you go. Granny flat provision. There's a bit of a mouthful there, Andrew. So let's give a quick introduction. What's a granny flat? What are the granny flat provisions that we're going to talk about? Who's it relevant for? Give us the intro.
So look, what we're talking about today is really, granny flat provisions for Centrelink purposes are a way for older Australians to be able to transfer assets to whomever. I'm going to say children because that's usually who it is, in exchange for being able to live in a property for life. So to basically have a life interest to live in that property without it counting as a gift. That's ultimately what we're trying to avoid here. Can get a little bit technical, can get a little bit, why would you even do this? So we'll run through like an example of how it works and how it's ultimately structured. But essentially it's a way to not enact the gifting rules, which we'll touch on for a second, through Centrelink.
All right. So from my end, because I need another coffee, so I might just simplify it down a little bit because I'm waiting for the neurons to start firing. So basically you've got, let's call it in the traditional sense, where you've got a parent who is living maybe independently and they turn around and go, look, I'm getting a little bit older. You as the adult child go, do you want to consider maybe living in the same spot? Not necessarily in the same dwelling, but let's have a granny flat, as in the building itself, like a little self-contained thing out in the backyard. Really popular in places like Queensland and stuff like that, although we are seeing it start to become more popular everywhere else. So conceptually, it makes sense, and it's a good idea simply because, you can keep a closer eye, you can deliver care services, all of the benefits that come with it. But then you run into the challenge of, if there's government support through something like the age pension, that may impact financially the decision to then enact that, simply because of the financial ramifications. So the provisions that we're referring to and we're going to talk about is essentially how is that treated from a financial aspect in the eyes of places like Centrelink. Because conceptually it makes sense for families to be able to do that if they get along and they're not going to kill one another. But at the same time, you don't want to run into trouble from a Centrelink perspective where all of a sudden, I go and live with my son or my daughter or whatever it may be, but Centrelink have now taken the age pension off me.
Yeah, exactly right. And where that may impact you is essentially, all right, let's say you're talking about that same, family unit where parents sell their family home in order to be able to move into a granny flat. And just to touch on, and we don't need to go into doesn't have to be a granny flat.
It doesn't have to be a separate dwelling.
Doesn't have to be a separate dwelling. It can be a room in the kid's house. So it doesn't even need to be an actual individual dwelling. Could be an investment property that's around the corner from where the kids live. So it could be a completely separate house as long as the parents don't own the asset and as long as that's passed on. And we say kids, but this is an interchangeable term for, carer, let's say. As long as the ownership of that asset is in the name of the kids, doesn't impact the parents whatsoever.
Gotcha.
And it doesn't have to be, a granny flat in the way that you think of a granny flat. But if this wasn't available, or if this
the provision.
type of provision wasn't there, what would happen is, okay, parents sell family home.
Yep.
Say they sell a property for, I don't know, $1 million. All of a sudden, Centrelink is going to say, okay, well, Mr. Billy Amaritas and Samantha Amaritas, you've now sold your family home. And I use Billy because he's old, so he's not too far from.
I'm moving into your joint. What are you talking about?
Exactly right. We'll use that example.
Nice.
You've sold your home for $1 million. So you've gone from the way that Centrelink is going to view you, which is a homeowner with, let's say, no assets and in receipt of full age pension, to a non-homeowner that has $1 million sitting in a bank account. I'm sorry, but that's going to wipe out your age pension.
Done.
So what you then say is, okay, I'm going to gift that money to my child, and then I'm going to have assets that are going to be less than the assets test. And so I'm going to be able to receive age pension. Well, in come the gifting rules, and Centrelink says, if you gift someone an asset that's over $10,000 in value, that will count as an asset for 5 years. So even though you've gifted the money to...
you can't make it disappear.
Yeah, you can't make it disappear, or, the time frame for that money to essentially disappear is 5 years. And so
even if you, sorry, just on that one, Andrew, so if you gift the money, even though you may not be in possession of it, it's important to point out that Centrelink are going to assume that you've got access to, or that you still have that $1 million in this hypothetical example, and basically say, don't come and talk to us for 5 years because you're not eligible for anything. And that's that.
Exactly right. Yep. Yeah, exactly right. And so in comes the granny flat provisions.
Yep.
Right. So we'll use that same example. Someone has sold the family home, they move in with a child.
Yep.
They are able to gift a portion of those assets.
Yep.
And it doesn't always have to be a portion, but there's some tests that need to go into it. But they can gift a portion of those assets to the child. It's not actually a gift, so I'm not going to say it. So they give a portion of those assets to the child. And provided that there's an actual agreement in place. So you can't just say, hey, this forms part of
you need to document it correctly.
You need to document an agreement. So generally you need a lawyer to basically put it all together and say, hey, this falls under the granny flat provisions.
Yep.
Let's say you gift $500,000. Okay, well, you're allowed to have, $500,000 in assets. So you can still have, of that $1 million, you can still have $500,000 sitting in your bank account, your super fund, whatever it is. You give $500,000 to the child. That is a life interest to live in their property. So it's basically, consideration for you to be able to live in that property until, touch wood, the point in time that you pass away. And that $500,000 that you've given does not count as a gift because that falls into the granny flat provision.
Yeah. So basically, that's the way, assuming that that's your circumstance. Under that scenario, that would sidestep the gifting, call it the roadblock with Centrelink.
Correct.
And that $500,000 that you've given away is not counted as your asset, assuming that you tick a few of those boxes. And one of those things, just important to point out, that what it does do is it creates a life interest in that property, meaning that you don't own it, but you have the right to live in that for your life, essentially.
Yep. Exactly right. Now, there are some, considerations. So you do need to, and with something like this, I mean, it's naturally expected that you're going to receive advice, but there are some considerations. There's a lot of considerations that you need to take into.
They're quite reasonable and they make sense too, right?
Yeah. I mean, look, you need to understand that, let's say you're talking about the kids for argument's sake.
Yep.
It's still an investment property. So even though, parents might be living in a property, if it's a completely separate dwelling, you're still going to be paying your land tax. You're still going to be paying all of your expenses that are on an investment property. You're still going to be paying capital gains if you sell the property in the future. So there's still, some of those considerations versus, an individual or a parent that's just living in a property and you inherit it at a future point in time. There's a reasonableness test.
Yeah, I think with that one, that's a really interesting one to point out as well too. You cannot, the money that you give in this instance, in order to gain the life interest in the property or the dwelling, has to be commensurate with what you're receiving. So you can't, it'd be considered unreasonable if you give $1 million and you get, a 3x3 square meter room in a basement with no windows, right? Like, it's got to be in line. It's got to pass the pub test, essentially.
Well, it's got to pass the actual, there's a formula test.
Yeah, the pub test.
Yeah, exactly. Centrelink goes to the pub and they ask random people.
But yeah, I mean, that's, the reasonableness test has to apply as well too. So essentially, to sort of tie that off, it has to be commercially sound.
Yeah. It's a pretty simple formula. It's literally dependent on the age of the person that's gifting the money. And if there's a couple, it's the youngest person.
Yep.
So provided, that you don't go over that threshold, then it's fine. It'll still count as part of the granny flat provisions.
And if you do go over it, Centrelink will count that. They call it a deprived asset.
Yep.
So they'll count that, the excess, as a gift. So once again, you run into that territory that we were talking about originally, where if it's viewed as a gift in the eyes of Centrelink, you run into trouble because it starts to impact your Centrelink entitlement.
Yeah. Yeah.
So it's got to be above board.
Yeah, exactly right. Exactly right. Now, look, there's some considerations around, if you gift less than, I think that the extra allowable limit is at 247.
Yep.
So if you gift less, or if you give less than that, then you're still considered a non-homeowner. So you might still receive some rent assistance. So there is some, tweaking that you can do ultimately with a strategy to make sure that everyone is benefiting this to, the maximum degree. But getting advice is probably the most important thing in all of this.
So Andrew, in this instance, we're talking about, we've been talking about selling a family home and then doing something with your children, whether it's moving into a physical granny flat, like as in something in the backyard, moving into a room, or them then taking the money and purchasing another property. But what about property transfer? So if you've got that same arrangement and you want to transfer that to your kids, I mean, what does that ultimately look like?
It's basically treated in the same way. Yep. So a property transfer is still going to incur all of the same things that would happen. The only difference is that it's two related parties that are selling and then purchasing. So it's going to be treated in the same way as though, rather than, Billy and Sam selling their property and giving me $500,000, and, I go and purchase something else, I'm the one that's purchasing their property. So there needs to be a transfer of ownership. Mm-hmm. If there isn't a transfer of ownership, then it doesn't qualify as part of the granny flat provisions. So the parent cannot own the property. It actually has to be owned by the child or the person that's going to be the carer for that.
So in that instance, the parents can still reside in the property?
Yep.
Stamp duty is payable on the transaction?
Stamp duty is still payable on the transaction. You still need to transfer it and, purchase the property as though you would in a regular transaction.
It would create a life interest?
It would create a life interest in that property.
But in the eyes of Centrelink, the
parent has sold and
there's no
child has bought.
So realistically, there's no physical money. There's no consideration for it.
Well, there does need to be a transfer of physical money.
Okay, so let's unpack that a little bit, because that's a little bit confusing for everybody, right?
Yeah. So you would need to, sell the property to the child. Yep. The child would need to have the money, and whether it's in a loan or whether it's cash in a bank account, you need to have the $1 million to then give to your parents. Then parents are sitting there with $1 million in cash. Then they give, $500,000 for a life interest to continue residing in that property.
Got you. Yep. So I guess the thing to unpack there that's really important, because we are talking some pretty big numbers and there's some thresholds and bits and pieces. Realistically, you're not going to sell a property for 247 unless maybe it's a one-bedroom unit or what have you. But coming back to that reasonableness test that we were talking about before, it needs to make sense from that perspective.
Exactly right.
Yep.
Yeah, exactly right.
So it's not like you can sell a $2 million family home to your child, take the $2 million in cash, then give it back to your child and say, hey, we're going to continue living in one of the bedrooms, what have you, here's $2 million. And that's the life interest that we've got for, 10 years left of our life expectancy. That wouldn't pass the reasonableness test.
Yeah. And look, when you're doing something like that, you need to also consider the fact that, in the vast majority of instances, the child is going to be paying stamp duty on that purchase. So if you're going through that transaction, the risk is, and let's say that there's one beneficiary. So these are, all of the things that you need to put into the blender when you're formulating, do I even go down this route? Let's use that example where you're going to stay in the property, but you're basically going to transfer ownership in order to be able to, acquire the funds from Centrelink. Well, what happens if you go through that transaction? The upfront costs of doing it at a minimum are stamp duty.
Yep.
So you're probably paying minimum, in that example, 55, 60 grand worth of stamp duty in order to go through that. And that's 55, 60 grand worth of stamp duty in order to, be able to gift money and bring your assets down, usually for the purposes of being able to access age pension. What happens, touch wood, if those parents pass away in the first, let's say, 12 months, or, immediately after that transaction takes place? Well, all of a sudden, that one beneficiary, yes, they still own the house, so they're still going to receive all of the proceeds. But all of a sudden, rather than them receiving $1 million house, that moving into their name, no stamp duty, no absolutely nothing in terms of other than just, transfer costs and whatever, they still will own the asset, but they've already paid 55, 60 grand worth of stamp duty, all for the purposes of, the parents being able to access age pension, but not enough of a time frame to be able to realise the benefit. So you do need to, unfortunately, consider life expectancy, consider age, consider, how much benefit you're actually getting from Centrelink and age pension as to whether this is even a viable thing and something that you should be doing.
Yeah, that's a really good segue into some of the risks and considerations that we should be talking about too. I mean, just talking through it and listening to you say that, the level of complexity associated with this is quite high. A lot of the times that we see it, it can be quite an emotional time because it means that maybe the parents are, I wouldn't necessarily say losing their independence, but maybe a little bit, moving into a space that's near, occupied, closer to your children, whatever it may be. But if you get it wrong, if you think about somebody who's in receipt of the age pension and that's their sole income source, if you get this wrong and all of a sudden Centrelink see this and go, hey, you've made a mistake and you can't unwind it, you've made a mistake, we're going to take your age pension off you, that can be catastrophic and quality of life. Yeah. Assuming that it falls under the gifting rules, imagine going from the whole or the full age pension, all of a sudden it goes to zero, you're locked out for 5 years. So those 5 years, if you don't have any other income sources, then it's a pretty bad position to be in. So from that perspective, obviously we'll advocate for advice and close on that. But one of the other things to take into consideration is what happens if there's a relationship breakdown?
Yeah.
How do you deal with and treat that? And all of a sudden the parties are physically living closer together. All of a sudden you need to unwind that. Or maybe something a little bit more common is you've gone and, moved things around essentially, but maybe the parent needs to go into aged care.
Yeah.
How do you then fund the cost of going into aged care as well too? So a lot of complexity associated with it, which is why we're advocating to get advice if this is something that you're considering or looking at.
Yeah, absolutely. I mean, you definitely need to get advice if you're looking at something like this. And in addition to that, you definitely need to have someone who's experienced that knows how to draft these agreements up, because the last thing that you'd also want to do is, put together the agreement and realize that, hey, there's something missing or there's an issue. And all of a sudden, exactly, the scenario that you're talking about where Centrelink looks at it and says, no, this doesn't fall into the granny flat provisions and we're treating it as a gift.
Yeah. Yep. Andrew, well said, well summarised. It's a strategy that we're starting to see a little bit more and more of come through. I think that's been driven by just the higher cost of absolutely everything. People living longer. Maybe you're, worried about your parents and their health, and you want them living a little bit closer to you and things like that. But we're seeing a lot more of it from our perspective. So if that's something that you're thinking about or considering, or if it's pricked your ears and you want to get some more information, feel free to reach out to Andrew and myself and the team at 360, and we'll be more than happy to help out.
Thanks very much, Bills. Thanks to all of our listeners and our viewers. Like, subscribe, and we'll catch you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.